Thanks again for joining myself and Drew. Today we're going to be talking about the markets and the economy, really focusing on what happened in 2022. There's a lot to dive into there. And then we're going to give you some perspective on the markets historically, and then what we're expecting and looking at in 2023. So we'll jump in with a recap of 2022, and we'll get rolling. Thanks again for joining. Quick note before I get started here: there's a chat feature at the top of your screen. If you have questions as we go along here, please make sure that you type them into the chat box, and we'll answer those at the end. Okay. 2022 market and economic recap. It really was a year of uncertainty. And that uncertainty, if you go back to 2020, a lot of this was driven by how we reacted and implemented policies based on COVID. We're starting to see the impacts rear their ugly head of expanding the money supply by 40% over a 2-year time period. Obviously, disruptions with supply chains, and when you have too much money chasing too few goods, that's how you get inflation. And 40-year high inflation is kind of what everything was based off last year. The uncertainty around that, how are we going to react? How is the Fed going to try to contain it? And then you have all these other factors that kind of trickle off of policies and procedures around inflation. We'll talk a little bit more about inflation and what those numbers looked like last year and what they look like now on the next slide. But there was a lot of focus on the Fed and how the Federal Reserve was going to react to this 40-year high inflation last year, what they were going to do with their federal funds rate, what they were going to do with their balance sheet. Really one of the only tools that you can see the government and the Fed deploy to keep inflation in check is to raise interest rates, to try to slow the velocity of money, try to slow the economy down to control inflation. And we're going to, again, dive into more of that here in a second. But on top of inflation and interest rates, other things that impacted the economy and the markets last year, Ukraine and Russia, that conflict and what happened with the impact on energy and commodity prices. The price of oil shot up dramatically last year, peaked at over $123 a barrel. Commodity prices, when usually you think of gold and silver and those types of things, but you think of wheat, grain, fertilizer, that type of stuff. Ukraine's a big exporter of those types of goods. So that was impacted based on the Ukraine-Russia conflict as well. So when we have the impact of inflation based on overspending and supply chain issues, and you throw this on top of it, that's going to compound our issues in 2022. The next bullet point you see is the slowing economy, the fear of recession. There's a lot of talk last year around, are we in a recession? Are we going into a recession? What does that look like? We started the year with 2 consecutive negative quarters. And historically, that usually falls in line with the fact that you're in a recession. Last year, that wasn't an actual call for a recession. The third quarter and the fourth quarter both had positive growth compared to the year prior. And for the full calendar year of 2022, the GDP growth was 2.9%. And so we did grow last year. If you dive into the numbers, there's different factors that kind of play into that when you think about exports, inventories, those types of things, because there's definitely parts of the economy that were slowing down or that were contracting. And so we're going to talk more about recession, probability of recession, and what we're thinking for 2023 here towards the end of the presentation. But obviously that's a big fear. It's a big talking point of, are we in a recession going into one? Can the Fed do a soft landing, which Drew's going to talk about here in a little bit? Lower earnings growth. We did see earnings grow in 2022, and we are going to go over a slide here in a little bit about how fundamentally, the stock market should perform as earnings perform. A lot of times the market is forward looking, thinking that, okay, we are going to expect or anticipate earnings growth slowing down because of what's going on with inflation and interest rates and the Fed. And so the anticipation of earnings growth slowing down was built into the markets last year. Even though we did see earnings grow, it was at a lower rate than we have been seeing. Again, we're going to dive more into that here in a little bit. And the last bullet point on here is political uncertainty. Last year was a midterm election year. A lot of conversation around policies and what could be implemented going forward, who's going to win the House, who's going to win the Senate, and we have divided government. Okay? So there was a lot of talk about how that's going to play out. Historically, a midterm election year is pretty choppy, at least for the first half of the year. As you get into the third and fourth quarter, and there's some predictability around who's going to be in power in Congress, a lot of times that could help in terms of reducing some of the volatility, at least from an expectations standpoint. Historically, a divided government where the Republicans control one side, Democrats control the other side, historically, that actually bodes well for stocks. Okay, the news cycle, all that's going to be a little bit annoying. They're fighting, they can't get anything done. There's gridlock. For stocks and for the economy and the market, that tends to be a good thing because that means there's some predictability and understanding that major legislative changes probably aren't going to happen. So tax rates are going to stay the same, and other major legislative policies are going to either not get implemented or they're going to be moderated. So from a political perspective, there's a lot of uncertainty leading up to the election. Now that we know what we got, historically, it tends to be a pretty good thing when we see that divided government. So that's a recap of kind of the high level of 2022 and the market and the economy. As we jump forward here, I'm going to talk one more time here about the Fed, what happened in 2022, because there's a lot of focus on the Fed. Federal Reserve, again, to combat inflation, is really going to fight it with interest rates. Increasing the federal funds rate is one of the major tools or main tools that they use to combat inflation. During COVID, when we shut the economy down, the Federal Reserve cut the interest rate to zero. Obviously, we printed a lot of money and had a lot of stimulus, so a lot of money into the economy. To unwind that, the Fed was tasked to increase interest rates and try to slow down what we saw on the inflation side of things. You can see on the right-hand side of the screen here in that chart, going into 2022, Federal Open Market Committee got together at the end of 2021 to say, what are our predictions? What do we think is going to happen in 2022 when it comes to rising interest rates? How many times are we going to hike the federal funds rate? What we expect to see the federal funds rate at the end of the year? What do we think is going to happen with the CPI, Consumer Price Index? What's that number going to be at the end of 2022? And then the personal consumption expenditures, the PCE, which is their actual main focus in terms of the measurement on inflation. What's that going to be? So you can see their predictions. Going into 2022, they thought, okay, maybe 3 interest rate hikes. And if you just do the math, that'd be 0.25% at a time, because of the next step over to the right, you can see that the majority expected the federal funds rate to be at 0.75% at the end of 2022. CPI at 5.3, the PCE at 2.6. Well, you can see what actually happened in 2022. 7 times they increased the federal funds rate. At the end of the year, the federal funds rate was between 4.25 and 4.5%. Consumer Price Index ended at 6.5, and the PCE at 5%. So the predictions were dramatically on the downside, on the low side. We saw a lot of rate hikes and interest rates spiking, and that uncertainty and that volatility that was added to the markets, we'll show you here in a second kind of how that played out. and what we expect for 2023 we'll cover. The last bullet point on the left, you can see that the CPI peaked at 9.1% in June, as well as the PCE at 7%. So we have started to see inflation moderate. Okay, the rate of growth on inflation continues to go down. As we just talked about, 6.5% at the end of the year. So it is going in the right direction. The Fed increasing interest rates at the rate they're doing it is pulling back the rate of inflation, or rate of growth on inflation. And so we are seeing that play out. But again, it was much worse in terms of their expectations versus reality. All right, I'm going to pass over to Drew. Drew's going to talk about market returns in the equity markets, as well as what happened in fixed income. So I'll turn it over to Drew.
All right, thank you, Evan. So as Evan just described to all of us, 2022 was certainly a year of uncertainty and kind of a perfect storm of various factors that really led to this high rate of inflation, which led the Fed to act much more aggressively than they had anticipated. There's a common saying in the marketplace, don't fight the Fed. Typically, if the Fed's making major policy decisions, the market acts accordingly. 2022 was certainly no different. So if we look at the year-to-date column of the various indexes here of different equities and equity sectors, we can see at the very top there the S&P 500, which is kind of the primary index that we track. It's, you know, the 500 largest companies in the U.S. stock market, was down about 18% on the year, and this does include dividends. So from a price perspective, it was down close to 20%, which is considered a bear market. So while we didn't end the year in a bear market, we did eclipse the bear market a few times. First, I believe in June, and then again in September, going down about 25% at its low point. And if you take away the bear market from March of 2020 as a result of COVID, that's the first bear market we've seen. We've come close a few times, but that's the first bear market we've seen since the 2008 bear market. And generally, we look at the market as a leading indicator in terms of what's happening kind of on the ground. So from an economic standpoint, we discussed whether or not we went into recession last year or not. I think you can't deny that the economy certainly slowed from what we saw in 2021. And the market was kind of anticipating that, and it led with losses down about 20%. And then if you factor in dividends, down about 18%. But what I think is really important to keep in mind is we always want to maintain a long-term focus. And if you look 2 columns over, it's the 3-year cumulative return. Despite being down 18% last year, the S&P 500 is up 25% over the last 3 years. So if you just kind of take a step back and view things from the larger picture, while we never like to be down 18% in a given year for the stock market, we still recognize we're up 25% over the last 3 years. And if you look below that, we have the Dow Jones, which is also commonly referred to as, you know, kind of the market. You'll hear the Dow quoted a lot. The Dow was only down about 7% last year. And the Dow is normally much more value oriented. So we have our value stocks and our growth stocks. You know, think of a growth stock, kind of the Amazons or the Googles, the Teslas, kind of the more volatile stocks that are really looking to grow. And then you have value stocks, which have, you know, more dependable cash flows. They tend to pay a higher dividend. So the Dow is normally more value oriented, and it did far better than the broader market did, down about 7%. The third row down is the Russell 2000. Those are considered small cap stocks. And while they're small cap stocks, these are still, you know, companies worth billions of dollars, but they are smaller companies. They tend to be a little more volatile than the larger cap stocks. Those were down about 20%. But here's where we start to really see the disparity in the marketplace last year. Below that, we have the Russell 1000 Growth, which is the growth companies in the market, down 29%. And then below that, we have the Russell 1000 Value, down about 7.5%. But if you look over to that 3-year cumulative return, the growth companies are still doing better over the last 3 years. It's the first shift to value outperformance that we've seen in quite a while. Because when the Fed is keeping interest rates low, like they have for such a long time, really coming out of 2008, that's a good environment for growth companies. They tend to have a little bit more leverage as they're trying to grow. And if you can leverage at much lower rates, that tends to be to their benefit. And then what I think is pretty interesting here is the you'll see the third row from the bottom, the MSCI EFI index. That's the overseas markets, down about 14%. So it certainly was not a great year for the international markets, but it still outperformed the U.S. markets. And I think if you said, okay, we have this this conflict going on overseas between Ukraine and Russia, I don't think many of us would have expected that to outperform the U.S. market. And that's why we always want to remain diversification in our holdings. While we have a home bias and we have more of our equity exposure to the U.S., we always want some international equities in our portfolios as well. And last year they performed a little bit better. And then last on there, you'll see the NASDAQ, which is more of that tech growth heavy focus. And they were down about 32.5% last year. So, kind of think of the Facebooks, the Amazons, the Netflix, the Googles, the Teslas. Those are the type of companies you'll find in the NASDAQ. So on the right side, we have what we call the equity style box here. And you have the, along the left side there, L is for large, M is for mid cap, S is for small cap. But the story that we're really trying to tell here is that, and across the top you have value, blend, and growth. Across, whether it was a large cap stock, a mid cap stock, or a small cap stock, value outperformed. So regardless of what area of the market you were in, value definitely performed better. Still down, but much better than the bigger losses we saw on the growth side. On the left side of the screen here, we kind of have we have the asset class returns for various asset classes for all of last year. So you can see on the far left side, commodities were up. That speaks a lot to the inflation that we saw and that Evan told us about. Cash was up 1.5%. When's the last time we saw anywhere near 1.5% on cash? So we're finally starting to get a little bit of yield on our bank accounts and CDs, things like that. However, from a long-term investment perspective, we don't really want too much cash. We want to make sure we have cash when necessary and as an emergency fund, so on and so forth. But from a long-term investment perspective, while it was one of our better performing assets last year, 1.5% is still losing to 6.5% inflation. So that money that's in the bank, while we want it to be kept safe for the reasons, either emergency or saving for something that's an upcoming expense, it did lose 5% to inflation. And then the next two lines there, high yield bonds and kind of the broader fixed income market, bonds were down around 13% last year. That follows a minor decline of about 1.5% in 2021, which I believe is the only time we look at, it's called the aggregate bond index. That's the only time that it's ever been down in back-to-back years. So that happens when we see rising interest rates. When interest rates are going up, bond prices are falling. So we saw the worst year for bonds ever last year. 13% is the worst year we've ever seen in bonds, which normally we count on bonds to be that ballast to the portfolio. If we have a nice diversified portfolio of stocks and bonds, when stocks generally are experiencing volatility and declining, normally we have bonds to count on. But last year we kind of had, again, that perfect storm where the inflation that we were seeing required the Fed to act and act pretty strong. So as interest rates were going up, bond prices were going down at the same time that equities were going down, which we just saw on the last slide, down from 14% internationally to 18% for the S&P 500. And then real estate investment trusts, REITs there on the far right, were down about 25%. So last year there was nowhere to hide. But again, we always want to maintain that long-term focus. As we saw in the previous slide, the 3-year cumulative returns were still positive, pretty easily so, So we know that as stock market investors, we're going to have down years on average, about 1 out of every 4 years. And 2022 was one of those years. So just to dial in a little bit here on what the various fixed income returns were and kind of where key interest rates stand today versus where they were a year prior. If we look at the top little table there, again, we can see the year-to-date column. U.S. aggregate bonds in general, which includes treasury bonds, corporate bonds, mortgage-backed securities, kind of the full normal basket of bonds, down 13%. U.S. corporate bonds were down a little bit more than that, just shy of 16%. And while we never want to see negative 6.5%, municipals outperformed quite meaningfully. So if you have a non-retirement or a taxable investment account, there's a good chance we have some municipal bonds in there, so they perform much better. And then high yield bonds down about 11%. If we look at where key interest rates are today in the 12/30/2022 column, we can see that the 2-year Treasury ended the year at about 4.4%, the 10-year Treasury at about 3.88%, the 30-year Treasury at just shy of 4%. And if we look a few columns over, we can see at 12/31/21, the end of 2021, the 10-year was at about 1.5%, so it more than doubled. The 30-year was at about 1.9%, it went up over 2%. And really that short-term interest rate, that 2-year rate, was at 0.73 compared to 0.44 to end the year. Now interest rates have come down a little bit to start this year. The 10-year Treasury is just a little over 3.5% right now. That's kind of market expectations of, again, a continued slowing of the economy. As you can see here, at near the bottom, mortgage, a 30-year fixed mortgage rate, ended the year at 6.34%. Housing has been probably the hardest hit area of the economy, certainly one of, if not the hardest, and it's really a result of these mortgage rates. A year prior, it was at 3.33%, so up over 3% in a year's time. And then the last thing to point out is that prime rate. So the prime rate is the primary rate that big banks will lend at to their primary customers. So they're the big companies that are borrowing, getting bank loans at 7.5% versus a year prior, half of that at 3.25%. So again, the Fed is intentionally trying to slow things. And if a company has to borrow at 7.5%, that's really going to put that's really going to dampen growth versus when they could get it at just over 3% a year prior. So interest rates will remain high. We've seen them shift a little bit lower to start the year, but that's definitely something we want to keep our eyes on, and hopefully we'll see, but we're able to at least get a little bit of yield on our cash and our fixed income these days, and hopefully bonds will, kind of be the ballast of the portfolio that we long-term depend on them to be. So with that, I'm going to kick it back to Evan, and he's going to speak to us a little bit about some historical perspectives.
Thanks, Drew. Appreciate that. Drew just did a really good job of walking through the returns in a tough year and why those the returns happened. I did that on purpose and made him be the bad guy to do the return part of it. I will now walk through, and Drew kind of did this as well, the 3-year returns, but historical perspectives on the S&P 500, and we'll walk through a few other of these, is that it's important to understand that we've been through a lot over time. And this slide here is going to show you historically since 1970. What's happened, look across as the different events, the different crises that we've been through. You have, Nixon resigns on there. We have obviously the 2008 crash, 9/11, and you have some, some other like good events, like the iPhone being born. You have, different presidents being elected, and you can just kind of span the time here from 1970 to see everything that goes on. When you look at market returns or economic activity within a certain time period, 1 year, 2 years, there's a lot that goes on. But when you pull it back and you look at this this chart here, this picture, from 1970, if you put $10,000 into the S&P 500, At the end of that, as at the end of last year, that would be $1,895,677. Okay, so despite all this that happened, despite all the crises and events that we've been through, long term, the market has performed and it's performed really well. Okay, it's kind of interesting to note this on the y-axis on the left-hand side there. That's logarithmic scale. Basically, it's doubling, right? If we did a linear scale in terms of the dollar value going up, it wouldn't fit on this screen. It wouldn't fit on 100 screens. It'd be as tall as a skyscraper. That's how much money that the S&P 500 has turned $10,000 into 1.895 million over time. Staying invested, having that long-term focus, like Drew talked about before, it's crucial. It's really important. Whether you're young and you're just getting started, or if you're entering retirement, there's still a time horizon that we need to make sure that we're invested, staying invested. Obviously, we make changes along the way to address your certain unique situation. But this is a good piece to kind of add that perspective to crises and events that we've seen in the past. Second here. All right. Next up, the history of U.S. bear and bull markets. So this is going back to 1942. Drew had mentioned before, last year we entered bear market. Bear market as a 20% pullback from the peak. On the flip side of that, a bull market is a 20% increase from the bottom. And so this does a really nice job of representing bull markets versus bear markets. In the gray box on the left-hand side, the upper left-hand side, you can see the average bull market period lasts about 4.5 years, with an average cumulative total return of 155.7%. Okay, and if we didn't have COVID break that up there for that 1 month time period in 2020, those averages would be even bigger. The average bear market lasts just over 11 months, with an average cumulative loss of negative 31.3%. So as we look at this, again, time in the market is better than timing the market, right? So trying to understand, hey, when to get out, when to get back in, that's a difficult task. You don't want to miss out on the long blue bars that are going up. Cumulative average over 4 years or more than 4 years of 155%. Because the bear markets, while usually are more abrupt, they usually happen quicker and a little bit more painful over a short time period. The bull markets last longer, and you want to make sure you're participating in those bull markets. Okay, one more slide here on perspective from me. This kind of just piggybacks on the last 2 slides I was talking about, where staying invested is important. This is interesting because of the timetable on here. So going back to 2007. So 2007 through the end of last year, if we look at the average annual return on stocks, gold, 10-year treasuries, so bonds, CPI, Consumer Price Index, which is inflation, home prices, cash, and oil. So when we look at this, you can see immediately, because right, this is 2007, so right before the 08 financial crisis. You look at the stock line, immediately it drops 50%. Despite that, you're still seeing stocks return almost 8.5% over that time period. Okay, gold at about 6%, 10-year treasury, so bonds at about 3%. Under 3. CPI, so even including really high inflation over the last 12 months, or actually more like 24 months, CPI only averaged 2.5. Home prices at about 4. You can earn a little bit of money on cash. Drew talked about it before. We're actually starting to see that change with interest rates going up. And then oil. If we didn't see the spike in oil last year, actually oil would have been down since 2007. So again, keeping things in perspective, even with a 50% drop to start this timetable from 07 to the bottom there in March of 09, even with that, stocks still perform well when you take more time on and look at it over a long term. So again, hopefully that adds some perspective in terms of, yeah, we see some volatility, we have some tough times in the stock market, but over time, it's important to stay invested because, you know, if you just kept it all in cash, you would have lost out to inflation during this time period. If you would have just been in bonds over that time period, you just barely kept up with inflation. So there's different factors that are going to play into how successful you are with investing in your financial plan, and staying invested is a key part of that.
Yeah, I think it's pretty fascinating just to add on there that, you know, over a 15-year period, if we would have told you we're going to have the great financial crisis, the worst economic calamity since the Great Depression, the market's going to go down over 50%. We're going to have a global pandemic where the market goes down over 35% or about 35%. And then we're going to have the highest inflation in 40 years, causing another bear market at the end of that 15 years to say you still would have got about 8.5% return on your stocks. I think we all would take that. So just a really good job by Evan putting that all in perspective. And a few things that are a little bit counterintuitive that I want to talk about on this slide is, what does consumer sentiment mean for market returns? And what you can see here in the gray line that, you know, it's going up and down, that's the consumer sentiment. You can see on the right side of the screen right now, it's incredibly low. It actually got lower than the lowest point in 2008, and it got lower or about as low as the lowest point in 1980, there towards the left side, the last time we were seeing inflation like this. So when inflation is roaring like we've seen, typically consumer sentiment takes a massive hit. And with that, you'll see in the little box in the upper left-hand corner of the graph, in the 8 sentiment peaks. So when consumers are feeling really good about things over the next 12 months, the S&P 500 is up about 4%. When sentiment hits its trough, over those 8 troughs, the next 12 months, the market's up about 25%. So when people are feeling bad about the economy and the markets, typically the markets start to do really, really well. That's when we kind of find our bottom in the market. So the famous Warren Buffett quote, be greedy when others are fearful and fearful when others are greedy. That's historically been a surefire way to do quite well in the stock market. So we've seen consumer sentiment start to pick up a little bit here, and we've also seen the market here in January have a really nice month, up around 5% so far in 2023. So whether or not we've hit our trough, we don't know, but historically speaking, when we see levels like that over the next year, we tend to see really, really strong markets. And again, that goes towards what I mentioned earlier, where the market's that leading indicator, right? So the market was down and started going down by the time sentiment hit. And then when sentiment's at its lowest peak, the market tends to reverse course and go higher. But what I think is also key to understand here is that even when we hit the sentiment peaks, the market is still on average higher over the next 12 months. So generally speaking, as Evan has told us, it's important to remain invested because whether sentiment's high or low, generally the market's positive moving forward. And Evan hinted at this earlier as well. There's always going to be short-term noise, and the market's going to yo-yo up and down in the short term. That's why we, as he said, we want time in the market, not timing the market. No one can time the market perfectly, and certainly not consistently over time. What drives the stock market is earnings of the companies that we're investing in. So this goes towards the end of November here, but since 1972, so we're looking at about 50 years, the S&P 500 has grown the earnings by 34 times. So back in 1972, S&P 500 earnings were $6.17. Near the end of November in 2022, when the S&P 500 was at about 4,027. It's actually just a tick higher than that right now as we speak. Earnings are at $215 So that's an increase of 34. You can see on the third line, back then the S&P was trading at 118. Today it's a little north of 4,000. That's 34 times. So as earnings go, so goes the stock market. So that's why we always want to encourage our clients to, shut out the noise, shut out the disaster of the day, so to speak, as Evan showed us through that chart of all the awful and big headlines of different things that have happened. If we can focus on the fundamentals of how companies are doing, that's going to tell us how the stock market's going to do. In 2022, even though the market was down, earnings were still up, not the growth rates we've seen the couple of prior years, but still up. And a couple of other things that's really interesting in here is if we look at dividends in the S&P 500, averaging about $3.19 in 1972, up to $65 near the end of 2022. That's an increase of 20 times. And then if we look at that bottom line, CPI, up about 7 times. So when we think about the long-term perspective, our goal is to, at a minimum, maintain, but if not, increase our purchasing power so that we can keep pace with or outpace inflation. Dividends in stocks alone have almost tripled the rate of growth from inflation, despite the really high inflation we've seen. That starts in 1972, at the end of 1972, when inflation was just starting to roar itself. So this includes these really high inflationary times. And despite that, dividends from these companies have almost tripled the rate of inflation. So the story here is that earnings are what drive the stock market, and stocks are what allow you to hedge inflation. They're by far the best asset class long term in terms of outpacing inflation. Okay, so to wrap up, we've got a couple of slides to let you know what we're looking for in terms of 2023, and we've touched upon a lot of these as we've gone along today's presentation. So first and foremost, is the Fed going to be able to pull off the soft landing? About a year ago, the soft landing was, can the Fed start raising interest rates to avoid a recession? Well, that's looking increasingly unlikely that we may not be able to avoid a recession. We'll see how it unfolds. So that definition of a soft landing is kind of being expanded now to, can the Fed raise rates at the pace they have and keep it to a mild recession? I think that is certainly very possible. We'll see how it unfolds. But again, it'll feel a bit counterintuitive. If we're reaching recession, the market has likely seen that writing on the wall and potentially already started heading higher. So just because we go into recession does not mean that the stock market's going to continue going lower and lower and lower. We'll probably experience some volatility throughout 2023, but a recession certainly doesn't mean bad things for stocks necessarily, because the stock market priced that in last year. The second bullet point there, the majority of the Fed is expecting between a Fed funds rate of between 5 and 5.5% at the end of this year. Evan showed us how their expectations certainly don't always play out, how reality plays out. So we'll see what that looks like. But that would suggest another 0.75% increase in the federal funds rate. Right now, they have a range of 4.25% to 4.5%. They're actually meeting starting today, I believe, and will announce tomorrow what their next decision is. And I think the market expectation is that they'll raise it by 0.25%, so 0.25%. But the market has already basically priced that in. So what the market is really going to be looking at is, what does the Fed chair, Jerome Powell, what does he say in his press conference after they make their decision and release that decision? What is he going to say about how the Fed's feeling about future interest rates? So the Fed's hoping, or the market's hoping, that he'll be a bit dovish and start to say, okay, the Fed may slow or stop altogether, pause the rate of increase in the Fed funds rate. So we're really keeping a close eye on that for tomorrow. Corporate earnings, as the economy continues to slow, We still have high cost pressures. We talked about that prime interest rate being high in terms of companies that are borrowing from banks. Is that going to be enough for corporate profits, corporate earnings to continue growing or not? So that's, as we saw a slide ago, corporate earnings are what drive the market. So we're always keeping a close eye on that. Market interest rates, will bonds start acting like bonds again? So have we kind of hit our peak on interest rates in terms of rates increasing? If so, we can expect pretty decent returns from bonds this year, knowing we're getting around a 4% yield on bonds. And if we continue to see volatility, will bonds be that diversification that we have counted on over history? Last is employment. So while the Fed's main focus at this time is certainly inflation, they kind of have a dual mandate, as they say, inflation and employment. The employment rate's, I believe, 3.5% right now, or right around there, which is close to an all-time low. So from the Fed's perspective, another one of these counterintuitive things, the Fed wants that to go up, because if that's starting to go up, then the economy, that's proof in their eyes that the economy is starting to slow, and hopefully inflation continues to slow with it. So the Fed's trying to break kind of the employment sector of the economy. Now, while employment is low, we are seeing some cracks in the underlying data there. The participation rate is lower still than it was pre-COVID. So that means not all the workers are back to work quite yet. And also, we're starting to see some folks take on second jobs in order to combat the high inflation that we're seeing. So while the employment, the labor market is strong, there are some underlying cracks, and so we're going to keep a close eye on that to give us indications of what the Fed will be doing as we move throughout 2023. And with that, I'll send it over to Evan to wrap up with one more slide, and then we'll get to any questions that you may have to wrap up today's discussion.
Great. Thank you, Drew. Yeah, so we've gone through a lot today in terms of where we were last year, what we're expecting this year, add some context and perspective to what we're seeing and what we're looking at. There are always opportunities out there that we want to make sure that we are putting out there and addressing. Everybody's financial situation is different. Everybody's plan and unique situation has different opportunities and different time horizons and those types of things. So keep that in mind when we talk about the opportunities that we're seeing. But from a high level, if you see that the first one here, from an investing perspective, talking more about the stock market volatility can provide many investing opportunities. Okay, simply put, if you're still working and you're investing, in your 401k plan at work or just contributing to an investment account, dollar cost averaging, whether you're in a bear market or not, dollar cost averaging has always been a really effective tool to take advantage of opportunities when it comes to investing, where you're contributing every paycheck, for example, into a 401k, or on a monthly basis, you're contributing to an investment account. And so you're not trying to time the market, right? We're just trying to get into the market. If the market's down, you're buying at a lower point. If the market's higher, you're still purchasing, but you're buying less shares. Over time, dollar cost averaging is a great investment opportunity and tool that we encourage people to use. Again, based on your time horizon and your risk tolerance and your investment objectives, we're low. The stock market's low. So if you look at that graph I talked about from 1970 to now, over time the market's going to go up. And so if you have the opportunity to do this, buying low over time, it should pay off for you. So that's another opportunity. Interest rates, Drew just talked about, are bonds going to start acting like bonds again? And we believe they are. Interest rates on fixed income assets, so bonds and mortgage-backed securities, for using structured notes and portfolios, those types of things, higher interest rates. Maybe now when we run a projection of what's going to be the estimated income on a portfolio, we're getting 4% this year as opposed to 2% last year. So if you're taking 5% off your portfolio, we know a lot of that is going to be taken care of just off the interest and dividends and the yield on your portfolio. it's a really nice opportunity to actually earn some interest and get returns on those fixed income assets. Cash alternatives. Drew talked about now at the money market, at the bank or whatever, maybe you're starting to get a percent and a half, or whatever it might be. We can actually earn money on our cash. Okay, now everybody should have a set emergency fund, something they can get at quickly and easily. That's very safe. If you have excess cash, there are now opportunities. Drew pointed out on the fixed income slide, there's a 2-year treasury note is paying over 4%. And we're seeing it now that a 6-month, a 1-year treasury paying over 4%. So you can actually get some interest, some return, some yield on those cash positions for very short-term holdings or just some extra savings that you might have that you may not need now, but want to keep safe. You can actually make some yield on those cash alternatives, which is a great thing. The final one here, we're huge proponents of updating and reviewing and monitoring your financial plan. A lot of folks over the last few years are getting closer to retirement, in retirement, whatever that might be. Part of retirement planning, when we go through a plan, is probability analysis. We're trying to understand, okay, we run all these different simulations, 1,000 random market simulations to say, how successful are you going to be in retirement? What's the probability of success, given that we're going to have years like this? We're going to have bad years. We're going to have tough years, maybe 2 in a row. Maybe you retire and immediately the market goes down. How do you look in retirement? What kind of changes do you need to make if something like that happens? So updating, reviewing, starting a financial plan is crucial always. And we think it's very important to look at when we have years like this, just to see the financial health of your plan. I think that's it. We have about 10 minutes or so left to answer any questions. We can go look in the chat and see if we have any. And so give us 1 second to pop out of the presentation and go to that chat box. Again, thanks for joining us as we're looking to see if there's any questions. A quick note, we're going to post the webinar on our website, and then we'll be also emailing the webinar out to, because if you join late and you already just want to rewatch it, please share it with anybody that couldn't join. We'd love to have this out there. Let's see here.
And it doesn't look like we have any questions at the moment. We'll give it a couple minutes to see if anybody does. So don't be shy. If you do have any questions, of course, always feel free to reach out to us offline after the fact, and we're happy to help there. Let's see here.
Yeah, we'll just give it 1 minute, and then Jules have an announcement for a future webinar that we're doing here in February. It doesn't look, oh, here we go. We got one. All right. Hello, thank you for the great information. How do you think the recent announcements of layoffs will impact the economy, Amazon, Microsoft, etc.? Because you had that on your slide, I'll let you address that.
So I think it's probably one of those bad news is good news types of situation when it comes to the stock market. Obviously, it's bad news for the folks that were laid off and their families. We never like to see that. But oddly enough, at the time of those announcements, each one of those companies' stocks went up for a couple of reasons. One, again, it's counterintuitive, but while you're laying people off, that means you're not paying them their salary, their benefits, so profits likely go up with that. In addition to that, we spoke about how the Fed's, one of the Fed's primary goals is to start to break, so to speak, the labor market. So when the Fed starts to see big companies doing things like this, that's actually in line with what their goals are, because that means that these companies likely are accepting, okay, if we're not only not hiring, but having to lay folks off, we're having to do that, and it's likely going to mean a slowing potentially of their corporate earnings. So I would say in general, from a stock market perspective, it's neutral to good news. But on the economic reality of it, obviously that's not good news. because these are folks that are no longer going to be earning, if they're with Amazon, Microsoft, they're probably earning pretty meaningful income. So that's going to stunt economic activity because they're not going to be able to buy as much as they were, things like that. So economically speaking, that's not great news, but it kind of accomplishes the Fed's goal, which means it's somewhat good news for the stock market. Anything you'd add to that?
Well, I would add that the question kind of piggybacks on what we were talking about with growth stocks versus value stocks. Amazon, Microsoft, we've seen a lot in the headlines recently around layoffs coming from the tech side of the economy during COVID, or even pre-COVID, but especially during COVID. Tech companies hired a ton of people, okay, and probably so in a way that they were anticipating that kind of growth for a long period of time. Now that we've seen the ramifications of COVID and the policies put in place and the spending and the inflation that we've now seen, tech companies are going to lay off a lot of people, and they're going to continue to do so. And as Drew said, I believe that's probably weirdly a good sign for the markets. Again, neutral to positive from a market perspective. Obviously not great for folks who are being laid off.
Yeah, and so that's why it's such a thin gap for the Fed to shoot to accomplish their soft landing. If folks are going to be getting laid off, that's kind of the last domino to fall is the labor market in terms of the economy and whether or not we, officially slide into a recession. The National Economic Bureau of Research is who gets to officially declare whether or not we're in a recession. So as Evan said earlier, last year we had 2 negative quarters of GDP, which is kind of historically loosely been the definition of a recession. The other factor is a strong labor market. Manufacturing was still doing well at that time. They did not declare a recession. We've seen a lot of that data start to soften and kind of move into a contractionary type of situation. So the Fed, we don't envy their situation of them trying to achieve the soft landing. So that's kind of our thoughts there. Anything else?
I'll say the last point on that, and Drew mentioned it before, that when the layoffs happened, their stocks actually went up. I don't know what the return is year to date through today, but I believe the NASDAQ or those growth type stocks are up 7-8% for the month of January. That's kind of piggybacking on those layoffs and finally maybe recovering on the growth side. It doesn't look like there's any other questions at this time. Maybe we'll pause for another 10-15 seconds, see if anybody types in. And then I'll let Drew jump in with, we're going to do another webinar in February on a very important topic, and I'll let him talk about that here in a second. Okay, I'll let Drew go and we'll wrap it up.
All right. Well, thank you again so much for your time. We know your time's very valuable, so we appreciate you spending an hour with us this morning. Again, keep your eye out for the recording of this and feel free to pass it along. Evan mentioned we are going to be doing another webinar in February. We haven't quite set the date yet, so do be on the lookout. It's going to be on the Secure 2.0 Act. So at the end of 2022, Congress passed and it was signed into law, the Secure 2.0 Act. This has quite a bit in there. It won't impact everybody, but for example, the required minimum distribution age starting this year is now 73. It was 72. The Secure 1.0, the Secure Act, moved it from 70.5 to 72. There's a lot of changes in terms of retirement accounts and things like that. There's changes really to a lot of different areas that we work with clients day to day. So we'll likely be putting out a blog post here soon, and then we'll follow that up with a webinar. So please keep your eye out for that, and we hope you join us. And then just to wrap up, we know everyone's anxious to get their 2022 taxes filed. Documents have just started going out. We will send out an e-blast here within the next week or so, just as a reminder for kind of the primary dates that LPL expects to be releasing 1099s and things like that. So thank you again very much for your time this morning. We hope you found it valuable, and enjoy the rest of your day, and we will talk to everybody soon. Thank you very much.